So joining me now with more is Mark Newton. He's Managing Director and Head Technical Strategy at FundStrat. Mark, great to have you on the show this morning.
Thanks, Kristen. Great to be here.
Yes, so much to cover, but let's start with some of this trade optimism.
Yeah.
What could that mean for markets as the S&P is looking to extend its record at the open?
Well, I think we want to see signs of a concrete deal happening out of this meeting. It can't just be bluster and talk. And so the longer the meeting goes, I think the more progress we think we could have. We want to see not only agreements from China to buy soybeans, but a lift potentially of the export controls on rare earths, and obviously cover the fentanyl as well as the TikTok deal. So a lot of that can be covered in a short period of time. But I think it's important, and it's actually a great sign of progress that both China and the U.S. are coming together and sort of thawing, the recent trade escalation on both sides.
Yeah, as a technical analyst, where do we stand right now on the charts, and how could a Fed rate cut and these mega cap tech earnings change that?
Well, the Fed rate cut's been already priced into the market for some time now, so we're going to get likely 2 rate cuts by the end of the year and possibly 2 more by next fall. So that's already set in stone by Fed Fund futures. I think, look, markets are rising because of signs of optimism, I think, for earnings this week. So we have 5 of the Mag 7 that are going to be reporting. Huge week. We have BOC, ECB, BOJ, and Fed meetings all this week along with the meeting. So it's probably one of the more important weeks of the entire year with regards to actual data to study. Technicals have been very supportive. The one thing I would say is that a lot of this rally has come specifically just from technology and not from the other sectors. Like financials have been down in the last month. That's an important part of the market. It's the second largest sector. We want to see a broad-based rally start to materialize. And when you look at equal-weighted S&P, it's been unchanged for almost 3 months. So it is important that we really start to push higher in a broad-based fashion. Optimism really has been non-existent for the market. We've gone from an environment of fear, and now it's more begrudgingly bullish. People realize the market's taking off without them, and many need to meet their end-of-year targets and try to keep up with the S&P. So if that does change, and I do see that changing in the next couple months, that would be a time for real worry versus now when things are still a little bit more subdued with regards to sentiment. Momentum and breadth have been still arguably okay, but there has been a little bit of a tapering off. My thinking is November is going to bring about volatility. We can't just go up and away into year end. My target on the upside is right near 69.50, so we're almost there, and largely within the next week. I think it's going to need to see some consolidation before we can push higher into year end.
Consolidation, that would be different than a 10% pullback.
No, I think we'll probably get 3 to 5% sometime in November, which should be expected. The market's up 15% this year on the heels of 20% the last year and 20% plus the year before. So it's logical to think we get these consolidations for reasons that people really don't understand. As to what brings it about, I mean, that's trickier. But my thinking is tech has gotten well too extended. Any sort of weakness out of the likes of Alphabet or some of the others could bring about a temporary pullback in Mag 7. And hopefully other sectors can really help to sort of buoy the market at a time when the market really needs a group outside of technology to participate.
If we do see a pullback, consolidation, if you will, of let's say 5% in November, is that a buying opportunity?
Yeah, 100%. I think, look, we've seen zero evidence of any long-term trend deterioration. As I mentioned, investors largely have been on the sidelines, so the sentiment is not there to suggest a bigger market peak. And earnings have come in remarkably well, and the economy also is in good footing, despite some weakness in the labor market. So that's really what investors need to be concentrating on, is the fact that technically the market's in great shape on the heels of great earnings and a solid economy, and largely ignore a lot of the exogenous events that investors think should cause the market to be derailed, such as geopolitical activity or regular politics. And many of those have little to no effect on the market. Even tariffs, we know, have become watered down, and they've had really less of an impact on the broader stock market and the economy as of now.
Which sectors do you think are poised to outperform and catch up perhaps with technology?
Well, we've seen some catch up in healthcare, and that's been interesting because it's been non-existent. We've seen healthcare sort of be the whipping boy between both parties and out of drug price concerns, but that's played catch up just nicely. Utilities also has come to the rescue. I want to see financials really start to play catch up. That's really the most important sector, I think, for Q4 that needs to start to re-engage. We did see, of course, the issues with some of the regional bank credit issues. I don't think that is going to metastasized, I guess, across the sector. I think it was more of an idiosyncratic issue. We heard 6 big banks come out, and none of them mention any sort of credit issues. So I think the financials will be just fine. It's going to continue to be tech, though. We need to see tech as 30% of the S&P continue higher. Discretionary has started to come back. That's a good sign for the consumer. You might argue it's been some bifurcation, but honestly, consumer discretionary still looks to be in very good shape to me.
And as we see President Donald Trump, that is, over obviously in Asia, preparing for this high-stakes trade meeting with China's President Xi Jinping, how are you finding U.S. stocks versus international plays?
Well, we've seen a little bit of lagging in the U.S., and a lot of that has come on the heels of the Mag 7 being in consolidation mode over the last month. So many might look at stocks like Amazon and Netflix, and those stocks are really nowhere near all-time highs anymore. So we need to understand what's really causing the movement in the market. I like the U.S. going forward. I think the U.S. is going to be just fine. Mag 7 just last week has started to come back with breakouts in Apple, breakouts in Tesla. NVIDIA, getting back up above 195 is a very big positive. So, I think that the U.S. is going to be able to continue. And honestly, the U.S. is in better shape economically than the rest of the world. And so the dollar continuing to pull back, that could be good for a few emerging markets. But I see the U.S. winning the war over, certainly over Europe and doing much better heading into 2026.
All right, we'll be watching closely. Mark Newton, he's Managing Director and Head of Technical Strategy at FundStrat, joining me here in person at the Stock Exchange. Mark, thanks as always.
Thanks, Kristen.
Great to have you.